In 2016, US steelmakers have performed better than those in other regions, and it is most visible in the share prices. Since the beginning of the year, on average, US steel company share prices has increased by 70%. This compares to some decline in China and much more moderate 10 to 20% growth in India. We believe the main reason for such strong share price performance has been because US domestic steel price is significantly higher than that in the rest of the world. And this, of course, has led to much stronger operating margins. At the current steel price of about $700 per ton, the implied margin on operating cash cost basis is above $200 per ton. This compares to $65 in China. It is this spread in margins which has at least temporarily boosted steel asset confidence in the United States. At the moment, US domestic hot rolled coil price sells at about $700 per ton, and it is about $300 per ton higher than that sold in China. It is much higher than the traditional price premium between the regions of $100 to $150 per ton. And we think that there are two main reasons why this is the case. The first reason is associated with the landmark trade cases initiated last year on imports of hot-rolled, cold-rolled, and corrosion-resistant steels. Directly, these trade cases concern 22% of imports into the United States. And in form of anti-dumping and countervailing duties, the trade cases will provide some sort of defense from low-cost imports. The second reason is much higher industry consolidation in the United States, which has allowed for more aggressive price push from the domestic steelmakers. So the 5 largest steel companies in the United States control in the region of 70% of steelmaking capacity. This compares to 50% in Europe and about 20% in China. And this higher industry consolidation has helped to push for additional price increases in the United States, while demand environment has been relatively similar. As our base case, we do not think that the current price situation is sustainable. Globally, steel prices have come down sharply, and we believe that prices in the United States will follow, albeit more slowly. And the main reason why we have maintained this view is because we do not think that US is an isolated market. Yes, the trade cases discussed previously will of course limit trade of low-cost imports, but they will not stem imports completely. At such high price premium, arbitrage opportunities in the United States are plentiful, and traders globally will try to exploit it. They could try importing different types of steel not covered by the trade cases, or they could try importing steel from other countries. In fact, we have already seen some import displacement. In cases of cold-rolled and corrosion-resistant steels, imports of products from the countries covered by the trade cases have decreased sharply in the beginning of this year compared to last. However, at the same time, imports from other countries have increased. We believe that this displacement trend is going to continue and will ultimately eat into the regional price spread, thus forcing US domestic steel prices to come down.